Bankruptcy. Not generally a word you ever want to hear, but as an investor, there's a very real possibility you may have been affected by a company filing for bankruptcy, or with the current economic climate, there is a very real possibility you may be affected in the future. So you may have some questions like, what happens to my stock in a company that files for bankruptcy? And can you sell your stock if a company files for bankruptcy? And is your stock worth anything if a company goes bankrupt? To answer these questions, I'll have to explain what a Chapter 11 bankruptcy is and also what a Chapter 7 bankruptcy is. So in this video, I'm going to give you a brief overview of company bankruptcy in the US. In addition to this, I'm also going to discuss some numbers that you can look for on a company's balance sheet to help you decide whether a company is potentially a bad investment that could lead to bankruptcy. So make sure you stick around to the end, but if you want to jump ahead, the timestamps are in the description below. As always, if you get any value from this video, then I'd really appreciate you hitting the like button, as it helps the channel massively to reach more people. Also, if you're not already subscribed, then make sure you do, as you're missing out on some seriously helpful content. Now, before we get stuck in, I must be clear, I am not a financial advisor, and nothing in this video is intended to be financial advice. And if you want financial advice, you should seek a licensed professional. At the end of the day, I am just a guy on YouTube, so you should always do your own research, because this video is just for entertainment purposes only, and past performance is not indicative of any future results. So now that's out the way, let's get stuck into the video. So there are two main types of bankruptcy that companies can file for in the US. There are a few other chapters, but the two corporate ones are Chapter 11 bankruptcy and Chapter 7 bankruptcy. So what's the difference between Chapter 7 and Chapter 11 bankruptcy? And why would a company choose one over the other? So a Chapter 11 bankruptcy filing, also known as a reorganization or rehabilitation bankruptcy, is when a company files for bankruptcy, but the company still has a hope of becoming profitable again. In Chapter 11 bankruptcy, the company submits a debt repayment plan to the bankruptcy court, showing how they want to reorganize so that they can maximize creditor and shareholder value. For example, they can do this by cutting expenses, selling off assets, or attempting to renegotiate debts with creditors. In Chapter 11 bankruptcy, the business continues to run the day-to-day operations, but all significant business decisions must be approved by a bankruptcy court. A Chapter 11 bankruptcy case starts with the filing of a petition in a bankruptcy court. The petition may be a voluntary one, filed by the debtor, or an involuntary one filed by creditors who want their money. It's important to note that debt is not absolved in Chapter 11 bankruptcy. The restructuring only changes the terms of the debt, and the company must continue to pay it back through future earnings. A Chapter 11 filing has the company executives work with the creditors, and if they do not like the proposed reorganized plan, then the company or the creditors may even file for a Chapter 7 filing, which is also known as a straight bankruptcy or liquidation bankruptcy, and this basically means the company is dead. In Chapter 7 bankruptcy, the company stops all operations and it goes completely out of business. A trustee is appointed to liquidate or sell the company's assets, and the money is used to pay off the debt to creditors. Most companies do not initially file for Chapter 7 bankruptcy, and most will file for Chapter 11 bankruptcy first. This is what Toys R Us did back in the day, but then the courts decided there was no way the company would be profitable again, so they switched them over to a Chapter 7 bankruptcy. Chapter 11 sounds like the more attractive way to go for bankruptcy, because at least it offers some potential way to bounce back, but it's very difficult to pull off, as creditors will be skeptical. If your company had poor management to arrive at bankruptcy in the first place, it's hard to see how the same management can get them out of it. Lenders are less likely to want to lend money to a company that's just come out of bankruptcy, and if they do get lent money, it will be at a much higher rate. But there is always the chance the company will make it out of this. For example, you may remember back in 2020 that Hertz filed for bankruptcy due to the lack of customers in the pandemic, but within a year the company was able to recover by selling over 200,000 vehicles. Other examples of companies that filed for Chapter 11 bankruptcy and came out the other side are GM, Marvel, United Airlines, Delta Airlines, and American Airlines. So what does a Chapter 7 bankruptcy mean for shareholders, or what does a Chapter 11 bankruptcy mean for shareholders? When a publicly listed company ceases operations and goes into liquidation, the company's shareholders may be entitled to a portion of the assets, depending on the type of shares they hold. If it's a Chapter 11 bankruptcy, common stock shares will become practically worthless and will stop paying dividends. The stock may be delisted off major stock exchanges, and a Q may be added to the stock symbol to indicate that the company has filed for bankruptcy. If you try to sell the stock, then people aren't generally going to want to buy them. There is always the possibility that the shares regain value as the company emerges from bankruptcy. But as the reorganization of debt, the company may also cancel old shares and issue new ones, leaving little to the original shareholders. All of this is also true for preferred shares, but preferred shares are further up in the line for repayment in the case of liquidation. If it's a Chapter 7 bankruptcy, then there's unlikely going to be any value to your shares at all. Once all the assets are liquidated, there may be some value, but more often than not, there's no value left at all, and you may not get anything back. The owners of common stock shares are last in line for a share of the firm's liquidated assets, and often get nothing when a company enters liquidation, so the hope is a faint one. For example, suppose that a common stockholder owns 0.5% of the firm in question. If the firm has $100,000 to pay its common shareholders after that liquidation and other obligations, that owner would receive a cash payment of $500. Now, there is a legal hierarchy as to who gets paid first and last. Firstly, the government gets paid any taxes they are owed. Secondly, the secured creditors get paid, and this covers loans issued by banks or other financial institutions that are secured by a specific asset, such as a building or, for example, an expensive piece of machinery. Then after this, the unsecured creditors get paid, and these are companies that don't have a claim to anything but are still owed money, such as suppliers, utility companies, bondholders, and preferred shareholders. Then if there is anything left over, then finally it's the common shareholder paid last. So if you're a shareholder in a company going bankrupt, then you're not in the best position. This is why there is a massive sell-off in shares when a company files for bankruptcy, because the chance of you getting your money back is pretty slim, so people generally cut their losses. While bankruptcy may be unavoidable in many instances, there are a few things you may want to look at on a company's balance sheet to prevent investing in companies that may go bankrupt, and also so you know that the companies you're investing in are financially healthy and stable. So I'm going to do this using an example of Tesla. So the first thing you can look at is the current ratio, which is a liquidity ratio that measures a company's ability to pay short-term obligations or those due within 1 year. It's calculated by dividing the total current assets by the total current liabilities. Current assets are usually defined as cash or assets that will be turned into cash in the next year, and current liabilities are defined as those that will be paid in a year or less also. So in short, it's saying how many times over the current assets can pay for current liabilities. As a general rule of thumb, businesses should aim for a current ratio higher than 1. This means that they're in a strong position to pay off short-term liabilities. Anything greater than 1.5 is good. It's worth noting that a ratio under 1 indicates that the company's debt due in a year or less are greater than its assets, so it's a big red flag. In this case, the company basically owes more than what it currently has in assets in the next 12 months or less. So as you can see here, as of the last quarter, Tesla is currently at a current ratio of 1.35, so they aren't faring too bad. Another good measure to look at is the debt to equity ratio, or DE ratio. This is a measure of the degree to which a company is financing its operations through debt versus wholly owned funds. It reflects the ability of shareholder equity to cover all outstanding debts in the event of a business downturn. This is calculated by dividing the long-term debt or the total liabilities by the total shareholder equity. The optimal debt to equity ratio varies wildly by industry, but generally speaking, a debt to equity ratio below 1.0 would be seen as relatively safe, whereas ratios of 2 or higher would be considered risky. When it comes to debt to equity, you're looking for a low number. So for Tesla, their current debt to equity ratio is 0.09. So that's great. So finally, another good one to look at is the book value. And this is worked out by taking the total assets minus the total liabilities. So this includes everything on the books, including short-term and long-term debt, short and long-term assets. Everything that is an asset or liability is used to make up the book value. So if this is negative, then it's a big red flag, as the company has more debt than it has assets. And in the case of an emergency where the company has to sell all its assets, then they wouldn't be able to cover the liabilities. So in this case, as a shareholder, you would unlikely get anything back if the company went bankrupt. So for Tesla, this is currently roughly around $35.4 billion. But you may have to do some calcs for this on other stocks, as it's not on macro trends, or if you can't be bothered to calc it yourself, then you can pay for it on some other sites. If anyone knows where to get this for free, then please help the community out and share it in the comments below. So anyway, that's it for this video. Let us know below if you've ever invested in a company that went bankrupt, and if so, what company was it and did they recover? Or if they didn't, did you get any money back? Or if you want to be controversial, then let us know in the comments which company you think will go bankrupt next. I'd love to know, and I read all your comments. Also, if you enjoyed this video or got any value from it, then please smash the like button, as it helps the channel massively. And if you want to learn more about personal finance or investing, I have loads of videos on my channel, so I recommend you check them out. And don't forget to subscribe and press the bell icon so you don't miss out on any future updates. It's been Ollie from Get Geek Finance. Thanks for watching, and I'll catch you in the next one.